We got a lot this week. CPI, let's bring in Marianne Bartels, Chief Investment Strategist at Sanctuary Wealth. You point out all these things, I've used it so many times, I'm tired of using it, but we're drinking from a fire hose, obviously, with all the policies and tariffs and Doge and everything else. But the market is, less than a point off its all-time highs.
Correct. The market is holding up remarkably well, considering all the political backdrop, all the executive orders, concerns about tariffs. We're in earnings season, economic data. And at the end of the day, when we're looking at earnings are up 16% for the quarter. And that's the best in 3 years. And I think that's what the market is paying attention to. I'm also surprised because tech has been the leadership, and we're really getting a rotation within that technology, and the market is still holding up. So I remain very bullish, Joe, and we have pretty aggressive targets for this year.
Very bullish. 7,200 to
7,200 to 7,400.
7,400. We're at 6,000.
74.
I did some quick math in my head. That's 20%, isn't it?
It is, and that would be 3 years in a row of 20% or more. And the last time we
90s,
did was the 90s.
Yeah.
But I also compared this market to the 20s.
Oh, good.
From 25 to 29. And it's really based on innovation. In the 20s, we had a lot of innovation. We had electricity and railroads and radio. You know, the 90s, we know the internet and computers. And now we have AI. And right now, it's estimated this year, companies are going to spend over $300 billion. That's a lot of CapEx. But the difference from the 90s is that they're using it with cash and equity and private equity. This is not leveraged the way it was in the 1990s. So again, I'm actually not just bullish for this year. I think we're still in a secular bull market that's going to go out to 2029, 2030. So my decade end target is 10,000 to 13,000 on the S&P.
Both of those fantastic periods that you mentioned were followed up with pretty spectacular declines, too. Is there something that punctuates it at the end, or?
Well, normally at the end,
it's different than 1990s because it's not leveraged and these companies have real earnings.
The punctuation point is excellent. Normally what I look for a major peak in the market is everybody has to be in, particularly retail. We don't have that. There's still a lot of cash, at least $7 trillion on the sidelines. Another little secret, and not enough people look at this, is New York Stock Exchange margin debt. And if you do a little bit of math on it, I kind of normalize the data, you have a very leveraged market, which is why markets come down so much. You got to get that leverage out. Not even close. And then I look at the technicals. I look at the fundamentals. The technicals still support significant upside. And then if this AI innovation really materializes, and it's also robotics, it's also Web3, crypto, it's the whole package of innovation that I think is going to drive this. And it doesn't mean we won't have another bear market. I still think we'll have one more bear market, but we'll recover and go on to all-time new highs.
The jobs numbers you thought were weak, but the revisions were strong, so nothing changed. We get a couple of cuts this year, maybe, and you think the 10-year yield is in a downtrend, which is not what you might think if there's inflationary expectations from tariffs and tax cuts.
In the near term, we just had a breakdown on the 10-year that would point to about 4.2. But our target for the year is to be range-bound between 4 and 5 because the economy is growing really strong.
So you don't think 4? You think between 4
We'll
and 5?
range between 4 and 5. But,
Okay.
I mean, if the economy stays strong, you know, at some point, I wouldn't be surprised if we're back up near 5.
It's Head and Shoulders.
It's an inverted head and shoulders pattern, so we technically broke down from that.
So you mean that's lower for the 10-year yield?
Near term, about 4.2.
Okay, not for the bond. It's not for the note itself, but for the yield going lower.
Yeah. So, you know, at least the yield environment is positive.
Well, that's weird. That's not implicit. That you wouldn't think that necessarily.
No, but that can reverse out with PPI and CPI this week. So we're going to be watching that
Coming
very
again
closely.
this week?
Yep. And we have Jay Powell speaking
coming.
Before Congress
Never stops.
tomorrow and Wednesday.